Most businesses treat GSTR-9 like annual housekeeping. This year, it is not just a form, it is your first line of defense against GST scrutiny. And there are three specific changes for financial year 24-25 which can trigger notices faster ever than before. Why GST for 24-25 is different? As we approach 31st December deadline for financial year 24-25, I want to shift your focus from compliance to audit readiness. The days of treating annual return as just a simple consolidation of 12-month return are over. The portal isn't asking for just data anymore. It wants explanation because GST department's backend system is fully algorithmic and can easily track spillovers and pattern mismatches. The threshold for the current year remains standard. GSTR-9 is mandatory for turnover above 2 crores and GSTR-9C turnover more than 5 crores. But the real story lies in the new reporting requirement. There is a decisive shift where the portal demands you to explicitly tag your spillover effects. There are three specific changes you should focus for the financial year 24-25. 1. The spillover trap. For the first time, there is a dedicated table to isolate ITC pertaining to previous year but claimed during the current year. So, why does this matter? Because it ensures you do not claim an excess ITC. If you get this allocation wrong, you are inviting a notice for an excess ITC claimed. Second, Rule 37 versus 37A segregation. The department now wants you to separately show reversals because you did not pay your vendor versus reversals because your vendor did not file their return. You can no longer lump these into other reversals. Remember, your vendor's behavior now can cost you your credit. 3. Table 8A is now purely GSTR 2B. The shift is complete. We are matching data against static GSTR 2B and not dynamic GSTR 2A. If an invoice isn't in 2B by 31st of October, Table 8A will not reflect it, and you face a hard blockage on that credit, meaning that credit is dead for the year. No exceptions, no manual adjustments. So, how do we navigate this? Let me help you with what you should not do. Do not ignore other income in your P&L. If you have interest income, forex gain, or corporate guarantees, ensure they are reconciled. Do not rely on netting off. If you have expense reimbursement netted off in your expense ledger, department views it as underreporting of turnover. Gross it up. What you must do reconcile with books, not just returns. Your GSTR-9C is a reconciliation with audited financial, not GSTR-3B. Any unreconciled revenue is effectively a confession of tax evasion. Do rely on recent case laws. If you have an interest liability, remember there was a recent ruling by Madras High Court on Isha Motors, where it was held the interest is to be calculated on that net cash liability and not the gross liability if the cash ledger had sufficient balance. Finally, a tip most companies miss. Use the notes section in GSTR 9C strategically. If you are taking a position, that is contrary to department's view. For instance, claiming an ITC on immovable property based on Supreme Court verdict on Safari retreat. You must disclose it in your reconciliation statement. Silence here is viewed as suppression. Declare it. So let's file by mid-December before portal load slows down. A clean GSTR-9 isn't just compliance. It is the best insurance policy you can buy for the next 3 years of assessment.